Hey everyone, welcome back to Corporate Decoder. Today, FabricAI just filed its proxy statement for its 2026 annual meeting, and I'm seeing a lot of dilution coming. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is packed with details about upcoming votes and financial performance, but the real story is the sheer number of shares potentially flooding the market. So FabricAI Incorporated is holding its annual meeting of stockholders on the 18th of June 2026, and they're asking for votes on several important proposals as outlined in this proxy statement. We will quickly go through the key points to understand what is happening. First up, they are asking for stockholder approval to issue shares of common stock under various agreements, including convertible preferred stock and warrants issued in April 2026. Essentially, they are planning to issue a massive amount of new shares, potentially more than 20% of their outstanding stock at prices below standard market rates. This is driven by financing needs following a private placement that brought in significant cash. They've entered into agreements that could lead to a lot more shares hitting the market if approved. The company explains this is crucial to fund ongoing development and for general corporate purposes. However, the big consequence for existing shareholders is dilution. If these new shares are issued, your ownership percentage of the company will decrease. The details of these agreements are quite complex, involving Series K and Series J convertible preferred stock and accompanying warrants. The company is essentially committed to issuing shares that could significantly dilute current shareholders. The reason for this massive potential dilution is tied to the need for substantial capital. This agreement with Kopin Corporation involves significant payments and potential further stock issuances. FabricAI Inc. has agreed to pay Kopin up to $15 million for development work and another $15 to $25 million if things go well. And as part of this deal, they've already issued shares of Series J preferred stock, which converts into common stock. The potential issuance of all these shares from convertible preferred stock and warrants could be substantial. The company acknowledges that this could lead to a material dilution for current stockholders, meaning your ownership stake could shrink considerably. This is a major concern for investors as it directly impacts the value of their holdings. Then we have the incentive plan amendment proposal. This is about increasing the number of shares available for stock-based compensation to employees and directors. They are asking to increase the number of shares available for issuance under their long-term incentive plan from 400,000 to a whopping 5 million shares. This is a massive increase of 4.6 million shares. This means the company is planning to grant a lot more stock options and other equity awards in the future, which will further contribute to dilution. While equity compensation is a standard tool for attracting talent, this significant increase suggests a strong reliance on it, possibly to offset lower cash compensation or to incentivize performance in a challenging environment. It is important to note that these equity awards have tax implications for both the company and the recipients. The company may receive tax deductions for these awards, but also faces potential limitations on tax deductions for executive compensation, which could influence their compensation strategy. The Say on Pay proposal is an advisory vote on the compensation of their named executive officers. Essentially, stockholders are asked to approve the compensation package. The company emphasizes that their compensation philosophy aims to attract, retain, and motivate executives by linking pay to performance and aligning interests with stockholders. Looking at the compensation table for 2025, we see that Joshua Silverman, the Chief Executive Officer, received substantial option awards with a grant date fair value of over $1.3 million. Gilbert Villarreal, the president of Aero Operating Company Incorporated, also received considerable compensation, including over $1.2 million in other compensation likely related to consulting services. Joseph Ramelli, the chief financial officer's compensation was more modest but still significant. The pay versus performance table shows how compensation aligns with company performance. For FabricAI Incorporated, the data indicates a somewhat disconnected relationship between compensation actually paid and total stockholder return, especially in 2023. While the company's net loss widened substantially in 2025, the compensation actually paid to the CEO remained high, suggesting a potential disconnect between executive pay and overall financial results. This pattern of high executive compensation, coupled with significant stock issuances and potential dilution, might remind some investors of companies like Sears before its bankruptcy filings. When a company needs to issue a large number of shares at lower prices, it often indicates financial distress or a need to raise substantial capital very quickly. Historically, about half of microcap companies that engage in significant dilutive offerings like this see a substantial decline in their stock price in the following year. A $1,000 investment in such companies prior to these events has on average declined to $200, $400 over the next 12 months. Regarding the audit committee, they've appointed Stefano Slack LLC as their independent registered public accounting firm for 2026. The company notes that they changed auditors multiple times in 2025, which can sometimes be a red flag. They transitioned from Markham LLP to CBA CPAs PC in April 2025, and then to Stefano Slack LLC in September 2025. Frequent auditor changes can sometimes suggest underlying issues or disagreements about accounting practices. The fees paid to Stefano Slack LLC in 2025 were over $57,000 for audit fees. Non-employee directors received significant compensation in 2025, with stock awards making up a large portion of their pay. Greg Schiffman, for example, received over $142,000 in stock awards. This compensation structure is typical for non-executive directors, but it highlights the company's reliance on equity to remunerate its leadership. Looking at the security ownership table, we see that Iroquois Capital Management LLC is a significant holder with nearly 10% ownership. Joshua Silverman, the CEO, also holds a substantial stake. However, the potential dilution from all these upcoming share issuances is a major point of discussion. FabricAI Incorporated is clearly in a capital-intensive phase, seeking to fund significant development and operational needs through substantial equity issuances. While the intention is to fuel growth, the sheer volume of potential new shares raises concerns about dilution for existing shareholders. The company's decision to increase its equity incentive plan pool significantly further reinforces this outlook. The frequent auditor changes are also a point of attention. What I am actually looking for is a clearer path to profitability that does not solely rely on massive stock issuances. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like this video and subscribe for more, and join our Discord community, all linked in the description.